Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, we'll look here at a quick chart of the CDD. This is, of course, the U.S. Versus the Canadian dollar, and certainly the Canadian dollar has definitely maintained its strength against the U.S. dollar, despite the fact that the U.S. dollar has been strengthening against a number of the other major currencies. What we can see here is an example over the last well, in this case, we're looking at almost 6 months, where the CDD has been very range-bound. I mean, there's been some pretty big currency swings here, but it's been very range-bound. And you can see that by just understanding the whole concept of support and resistance identification, we're able to look at some very important levels within this particular pair value chart. So you can see here that, first of all, this 102 level has been a level that has been tested on a couple of occasions. You can see that in this case over here, we tested and we bounced off of that, had a secondary sort of a moderate test very close to that range, and then move forward. We then move on, and we can see that we also had another scenario where the particular pair value settled back down into that support, and then in fact took off and moved higher. And then more recently, we had another consolidation phase within that particular zone as well. So the observation that we would make here is that this is a very important support level, and a break of that level is likely to, and again, we're always dealing with probabilities, but is in fact likely to migrate its way down to retest some of these lower levels here. Once it's broken. And of course, yesterday we had a little bit of an attempt to push higher, but the CDD, of course, is now trading roughly around the 101. I don't know what the exact closing was, but in and around 101.43, 101.44. So what happens in this scenario here is that this 102 level, once the pair value is broken below that, changes its role from support to resistance. And if I can identify that a little more clearly, what you'll notice as well is that back up in this 104 level, you can also see that there was significant amount of consolidation off of this 104 zone in here, and on several occasions broke back up to retest this 107, 108. We then retested, and you can see that the had a little bit of a bounce, slight consolidation, but then broke through. Showed a little bit of resistance in here, finally broke through, made its way up to this previous resistance level, and so on and so forth. The point that I'm trying to make here is that these levels that have been tested on so many previous occasions become very important as the market moves forward in establishing specific price targets. So at this stage, what one might be able to deduce about the U.S. versus the Canadian dollar is that, and again, this is my opinion, and certainly not something that I'm recommending here, but the idea is that until we in fact break back above this 102 level here, we really have to be open to the possibility and the probability that the U.S. dollar is going to continue to slide against the Canadian dollar. Now, once we see some consolidation within this zone and perhaps a break above, we can use these previous resistance levels as a means of establishing targets for short-term trades. Okay, and all we've really done here is we've simply just looked at levels where the pair values have consolidated, where the market has held its value, where the CDD has held its value, or has rejected off of certain price levels, and we're using those levels to establish sort of benchmarks to determine our particular directional bias. Now, we talked a little bit about earlier on just about the idea that as a technical analyst, we have to kind of break down the chart itself and look for a number of different signs that are supporting our particular directional bias. So one thing that we'll add to our price chart are a couple of confirming indicators. And the idea is that there are literally hundreds of different types of confirming indicators that one might look to add to their charts. But the bottom line is, again, we want to keep it as simple as possible. We want to look at really just keeping our charts as clear as possible and as clean as possible, and using again, the laws of probabilities to work in our favor, so that once we've moved through our analysis, that we have a comparison of signals that in fact line up to suggest that what we've derived from our price chart is indeed the appropriate direction to trade. So what we want to look at here, just as we follow through with the rest of the presentation, is looking at our MACD and looking at our relative strength index. Now, again, just another comment about using confirming indicators. We talked about success in the markets being about putting probabilities on our side. And again, I can't stress enough that this business is about probabilities. And the fact is, anytime that you enter into a trade, regardless of how much time and effort you put into making the analysis, you always want to make sure that you have an exit strategy as well. Now, when we look at various chart patterns and indicators and such, we're really trying to have everything line up, obviously lending credibility that there is going to be a particular move taking place. And from there, we'll look at our confirming indicators as well to lend further credibility. The bottom line is that when all of them agree, then we have a higher probability of being correct. Now, there's a quote that I always like to throw out there that was published by John Bollinger, and of course many of you guys have probably heard of Bollinger Bands and such. And his quote is such that one of the cardinal rules for successful use of technical analysis requires avoiding multi-collinearity, and that basically million-dollar word there just suggests that many people look to use any and every indicator they can possible because they think that it makes them better traders. But the fact is, there's only so many pieces of information that any one indicator can calculate, and what a successful technical analyst has to do is find indicators that are analyzing different pieces of information instead of putting 3 or 4 different indicators in place that are telling them essentially the same thing. So what I've done is I've just kind of broken down some of the different types of indicators that one might look to utilize. We have our momentum indicators, in which case we're going to talk about our relative strength index, but you can see here that we have a couple of different examples there. We have our trend indicators, such as our moving averages and our MACD, and we're going to talk about, focus on our MACD this afternoon. And then you have volume indicators, such as accumulation, distribution, on-balance volume, and such. Now, the volume indicators, when we're talking about FX options, aren't necessarily going to apply so much because we're talking again about a notional index. So there are no shares being traded back and forth on that particular index. So you're kind of going to have to step aside from using that one in terms of a tool on your charts.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.